I'm going to present chapter 4, which is about capital market, equity and bond market. For the introduction, capital market refers to the market in a longer term financial asset, which is like first corporate stock. There is no fixed maturity period, and the second one is the public and private debt instrument, which is the maturity exceed 1 year, and it is a complement the banking system. And the next one is function. The function of capital market. Firstly is to fulfill the need of surplus unit by offering various investment tools, and next to provide a wide variety of instruments to the surplus unit to diversify their risk. And the third one is to provide intermediary service to raise funds for corporate investment and expansion and in changing ownership structure of companies. The fourth one is to assist the process of economic development, and the last function of capital market is to promote private enterprise, which is diversification of Malaysian economy. Next, let's move to the structure of capital market. There is 5, which is first is the equity market, the second one is the government securities market, the third one is the corporate bond market, fourth one is the financial futures and option market, and the last one is the Islamic capital market. Equity market environment. 1. Trade long-term securities. Equity market environment, trade long-term securities. Number 2. Corporation can raise fund by issuing new shares, which is initial public offerings, and trade shares in a secondary market. Okay. Third, trading in Bursa Malaysia under supervision of Security Commission. There have 2, which is ordinary shares and preference share. Number 4, common stock. Security that represent a portion of owner's capital in a business. Okay, after that, the parties in capital market. There is a lot, which is like individuals, financial institution, government, corporation, brokers, dealer, exchange, rating agency, underwriters, market analysts, fund managers, and regulators. Regulatory structure. Regulatory structure can be divided into 2, which is legislation and regulatory bodies. As you can see, below the legislation, there is Capital Market and Services Act, there is Securities Industry, Securities Commission Act, Companies Act, Offshore Companies Act, Labuan Financial Services and Securities Act. And for regulatory bodies, there is Securities Commission, Companies Commission, Bursa Malaysia Security Berhad, Licensing Officer, Foreign Investment Committee, which is FIC. Next subtopic for chapter 4 is index and average. Index. Index is a current price behavior of a representative group of stock in relation to a base value set at an earlier point of time. Okay, for average, it is arithmetic average price behavior of a representative group of stock at a given point of time. Okay, that is the purpose of index and average. There is 2, which is the first one is to measure performance of the stock market, which is there is in a bullish or bearish, and the second one is to forecast their future market behavior of a particular stock market. And there is some example of index and average, which is you can see on this slide. There is 5. First, Dow Jones Industrial Average, and second, Nikkei Index, next Hang Seng Index, next Bursa Malaysia Composite Index, and last FTSE 100. And the next subtopic is Bursa Malaysia Composite Index. Bursa Malaysia Composite Index have 100 stock listed in Bursa Malaysia main board. And to compute BMCI, aggregate market value on current date divide by aggregate market value on base date and times 200, where the aggregate market value equal to the market price times to the number of shares outstanding. And the criteria of Bursa Malaysia Composite Index is first, company gives substantial contribution to Malaysia's economy. Second one, large market capitalization. And the third one is newly listed companies must be traded at least 3 months.
The new index in Malaysia is FTSE BM 100 Index, FTSE Large 30 Index, FTSE BM Mid 70 Index, FTSE BM Emas Index, FTSE Small Cap Index, FTSE BM Fletching, FTSE BM Palm Oil Plantation Index, FTSE BM S Index, and FTSE BM Emas Syariah Index. The top 10 constituent is Public Bank Berhad, Tenaga Nasional, Malayan Banking, CIMB Group Holding, Aziata Group Berhad, Petronas Chemical Group Berhad, Genting, Sam Darby, Plantation, Digi.com, and IHH Healthcare. Brokerage firm. Brokerage firm is intermediaries between investor and operation of exchange. To trade a stock, what investor has to do? First, open a brokerage account with a firm trading account and central depository system account. Second, the investor chooses the stock in which he wants to invest, place order. Third, brokers will place the order in the risk-score trading system. And lastly, the system will match the purchase and sale order and complete the transaction. Type of market. In equity market, there are two types, which is primary market and secondary market. Primary market is market through which companies raise capital by issuing new securities. Meanwhile, secondary market is market where equities are rebought and resold after they have been issued. Primary market. The issuer, user or fund, sell the new stock security to yearly investors, suppliers of fund, in exchange for funds money. Then, a first-time public offering by a private company. These are also known as initial public offering, IPO. And then, a season offering is one in which the company already has stock that is traded on the secondary market. Secondary market, the trading process. First, with a stockbroking firm, open a trading account and a central depository system, CDS. Second, engage remedial. Third, placing an order at a stockbroking firm using the risk-score terminal. Fourth, match order. And then, the certification of the trade is print. Lastly, remedial confirm with his client. Others market is main market, S market, and lead market. Main market. The main market is a top-tier market for well-established business that meet certain criteria in terms of quality, size, and operation. S market. The S market is a sponsor-driven market for firms with strong growth potential. Sponsor must evaluate the eligibility of potential issuer based on factors such as business prospect, corporate conduct, and internal control adequacy. Lastly, lead market. The lead market is an advisor-driven market that promises to assist rising companies, such as small and medium-sized business, with improved capital market access and visibility.
Initial public offering IPO occur when a company first sells common share to investors in the public. Some of the reasons for listing is, first, to raise business expansion. Companies may need funds for the purchase of equipment, plants, and machinery for merger or takeover or for setting up business overseas. Second, to settle existing debt. In order to reduce financial risk, companies can restructure their debt position. Fundraised through IPOs can be used to settle or reduce borrowing from banks or bond position. Third, to enhance credibility and reputation. Meeting the strict requirements set by the regulators and authorities show that the company is of high reputation. The credibility leads to increase in confidence from local and foreign investors them to stimulate growth. Fourth, to obtain easier funds for future expansion. This can lead to future growth and increase competitiveness in future. Next, we're going to Bursa Malaysia Berhad. In Malaysia, Bursa Malaysia Berhad is an exchange that provides for both retail and institutional investors to buy and sell shares and other instruments such as loan stock, debenture stock, warrants, and bonds. Some of the vision of Bursa Malaysia Berhad is to regulate and maintain facility for concluding the wisdom of a stock exchange in Malaysia, to continually promote and develop capital market and protect interests and welfare of members. Bursa Malaysia Berhad owns Bursa Malaysia Securities Berhad, Bursa Malaysia Derivative Berhad, Bursa Malaysia Securities Clearing Sendirian Berhad, Bursa Malaysia Depository Sendirian Berhad, Bursa Malaysia Information Sendirian Berhad, Bursa Malaysia Bonds Sendirian Berhad, Bursa Malaysia Islamic Service Sendirian Berhad, and the latest one is Bursa Malaysia Regulation Sendirian Berhad. The risk of investing in stock market is as follows: business risk, financial risk, liquidity risk, purchasing power risk, market risk, interest rate risk. Next, we will move to common stock.
common stock is defined as an instrument that represents ownership in a company that issued the stock. It is also an instrument that many new companies use to raise funds and seeking listing in the security market through the initial public offering. A stockholder is a part owner of the company that issued the stock and has a claim on the earning and asset of the corporation. They are also entitled to any incremental profit of the company. Incremental profit means the ability to obtain a higher level of return in the form of dividend whenever the company is making higher profits. Some of the advantage investing in common stock is high return, voting and preemptive rights, easy to trade and low transaction costs, variety of choices, and liquidity. A common stock is not without any disadvantage. Some of the disadvantage of common stock is fluctuation of prices, lower current income, difficulty in determining the intrinsic value. There are 6 types of common stock, which is blue chip stock. Blue chip stock, these are the stock that belongs to large, well-established and financially strong companies, suitable for who want to buy and hold. Growth stock. Growth stock are those have recorded a higher than average sales, earning and dividends, suitable for those seeking capital gain. Income stock. Income stock are known for its stable records of paying higher than average dividends, suitable for those seeking high and reliable dividend payment. Cyclical stock. Stock that are more responsive to the change in the economy cycles. The performance of this company is closely linked to the economy cycle. Defensive stock. Stock that is less affected by the change in economy. Price tend to be stable during economic downturn. It is difficult to find, suitable for those who want to park their funds temporarily. Speculative stock. Some investors may prefer investing in speculative stock. These are stocks that the prices move drastically due to both fundamental and psychological factors and therefore can be risky.
Hi and Assalamualaikum. My name is NATASHA binti BAHARUDIN. I will proceed to explain the factor affecting the stock price. The first factor is economic factor. It is referred to the interpretations of economic variables such as GDP, interest rate, unemployment rate, money supply, industrial productions, currency value and also trade balances. Second factor is industry outlook. Looking at how competitive is the businesses, the regulatory conditions, industry life cycle, labor conditions and technological development. Third, corporate earning. The financial analysis will help investors to understand the earning conditions, sales level, dividends and other related decisions such as merger and acquisitions. Fourth factor is international stock market condition. A nation's stock market is also directly related to the performance of other bourses' performance. The next factor is crowd psychology. It is referred to the sentiment of the market, where it is important to look at the overall perceptions of investors to the economic condition. And the last factor is political scenario. It is referred to the political situations of a country, as this situation has a direct impact on businesses climate in the country. The investor will more favorable with the country that have a political stability scenario, such as smooth transactions of changes in leaderships or minimal changes in business policy. Next, we move to the second part of capital market, which is bond market. Introductions of bond market. First, bond market is another avenue participants in the financial system may use for the efficient movement of funds. Second, it also acts as intermediary where funds can flow from the surplus to deficit unit. Third, the environment in which the issuance and trading of debt securities occur. Fourth, it is a form of raising of funds that create the relationship of the lender and a borrower. Fifth, a bond is an instrument that indicates that the issuer promised to pay a periodic interest to the investor and repay the principal amount borrowed at the maturity. Next, the bond market also primarily includes government issuance securities and corporate debt securities. Moving on, the development of bond market in Malaysia. First, it has been dominated by government bond. And in 1987, the bond market is dominated by the Malaysian government securities by 98% issued mainly for financing of the nation development needs. Next, in mid-1980, the privatizations program has launched where lead to ringgit bond compositions in 1999, in which MGS 46% and PDS 27%, and the balance instrument were from Khazanah Nasional, Cagamas, Dana Harta and Dana Modal. Next, in the end of 2006, about 50.7% of bond outstanding consists of PDS, supported by BNM and Security Commissions. Now, in Malaysia, private sector bond is more than public sector bond. Bond issuer in Malaysia such as Government of Malaysia, Bank Negara Malaysia, quasi-government institutions, corporations and also Multilateral Development Bank. And last, Islamic bond based on Sharia compliant were also introduced as to complete the financial system in Malaysia at the end July 2007. Islamic bond accounted for 33% of total bond outstanding. Next, the bond feature. Here, the first feature of bond is it have a par value or a face value of 1,000 ringgit. Second, it also have a first priority claims on asset. Third, it also have a coupon rate which indicate as a percentage of bond par value that will be paid out. Fourth, it also have a voting right and fixed income in terms of coupon rate. And the last feature of the bond is it also have a maturity period, which as a length of time until the bond issuer return the par value to the bondholder. The advantages and disadvantages of bond. Here, the first advantages of bond is less risky compared to common stock. Second, it does have a fixed periodic return and it also have a priority in claims. And the disadvantage of bond is first, no incremental income. Second, drop in creditworthiness of bond issuer. Third, exposed to caliber risk. And the last disadvantage of bond is it have a lower return. And for the regulatory authorities of bond is the first here Bank Negara Malaysia, second Securities Commissions and also Companies Commissions of Malaysia. Beside here are bond market participants and their roles. The participant is financial institutions, investment bank, insurance companies, BNM, rating agency, corporations, foreign fund manager, Cagar Mas Berhad, Provident Pension Fund, Sharia Advisory Council and also bond pricing agency. And also, these participants have played their own roles to act as supervisory body, co-arranger, underwriter, guarantor, principal dealer, trustee register, authorized depository institutions and also as a paying agent.
First is Malaysian Government Securities or MGS. These are interest-bearing long-term securities issued by Government of Malaysia with interest payable semi-annually and having a tenure of normally more than a year. The funds raised will be used for the national development expenditure. Second is Bank Negara Monetary Notes, BNMNI, are Islamic securities issued by Bank Negara Malaysia replacing the existing Bank Negara Negotiable Notes, BNNN, for purposes of managing liquidity in the Islamic financial market. The instruments will be issued using Islamic principles deemed acceptable to Sharia requirement with maturity of 3 years. The third is Malaysian Treasury Bills, MTBS, are short-term government securities issued by BNM on behalf of the government to finance national expenditure. Bills are sold at discount through competitive auction facilitated by Bank Negara Malaysia with original maturities of 3 months, 6 months and 1 year. MTBS are auctioned weekly through the principal dealers on a discounted basis and redeemable at face value on maturity. Fourth is Government Investment Issues, GII, and Malaysian Islamic Treasury Bills, MITB. So for GII, these are long-term and short-term non-interest-bearing government securities, respectively issued based on Islamic principles by the Government of Malaysia. For the MITB, are short-term securities issued by Government of Malaysia based on Islamic principles. These instruments are usually issued on a weekly basis with original maturities of 1 year. Both conventional and Islamic institutions can buy and trade MITB. Next, BNM Bills, BNB, similar to MTBS, it is a short-term instrument with maturity not exceeding 1 year and issued on a discounted basis by auction through principal dealers. Since it is categorized as liquid asset, it is often purchased by financial institutions to meet their liquidity and statutory reserve requirement. After that is Cagar Mas Instruments, is an interest-bearing instrument issued by Cagar Mas Berhad, a national mortgage corporation. These instruments are related to the housing loans financed by financial institutions and the government. Instruments include floating rate bonds, fixed rate bonds, Cagar Mas notes, and Mudarabah bonds. Next is commercial papers. CPS is an instrument similar to MTBS where the tenors are no less than 1 month but not more than 12 months. For the medium-term notes, MTNS, instruments with tenors of no more than 1 year but not exceeding 5 years. The issues can be conventional or Islamic based on the mode of issuing is either direct placement or by tender. The last one is corporate bonds, are instruments issued by corporations, Islamic or conventional, fixed or floating, or can be issued without interest with zero coupon. The instruments are issued by corporations for the purpose of raising of funds for the business to expand. One important element of corporate bond issue not required for government bonds is the need for a rating to be done by the rating agency. In Malaysia, it is a requirement for any corporate bond new issue to go for the rating process. Move to the next is bond ratings. One of the risks in bond investment is the business or financial risk. It is the default risk or the risk of the non-payment of the interest and the principal at maturity. The lower the risk, the higher will be the rating. Higher rating means the issue has the ability to make a timely payment of the interest and the principal to the bondholder. So the other objective of a rating are, it provides a complete, accurate, and reliable information of the issuer of the bond. Also, it is a cost-effective marketing tool and an effective movement of surplus fund in a financial system. Furthermore, is brand rating scale and definition of bonds in Malaysia. As we can see, there is 6 scale and the first one is AAA. AAA is the best quality bond. It has the highest safety in timely payment of interest and principal. Next, for AA is high safety in timely payment of interest and principal. For A is adequate safety in timely payment of interest and principal. It is sensitive to changes in economic condition. Moreover, there is BBB, is moderate safety in timely payment of interest and principal. It is lacking in certain protective elements. Then, for BB, it is inadequate safety in timely payment of interest and principal. Also, it is future condition not well assured. And for the last is B, is high risk on interest and principal payments. Also, it adverse business and economic condition would lead to lack of ability to pay interest and principal. Okay, so the next part is bond valuation. Bond pricing is based on the present value of all future expected stream of cash flow to be received by the bondholders. The cash flow of bonds can be divided into two. The first one is the interest income and the second is the principal amount, which is received at maturity. Thus, the value of a bond is the present value of these two components. So the formula is price equal with present value of annuity plus with present value of par value. The last part is bond yield measures. There are two types of yield in bonds. The first one is current yield and the second one is yield to maturity. For the current yield, a measure of return of current income relative to the market price of the bond. It is derived by relating the amount of interest received periodically to the market price of the bond. So the formula is CY equal with annual interest divided by market price of bond. For yield to maturity, rate of return an investor earn for holding the bond until maturity, which is fully compounded. To find this yield, investors need to apply the formula for finding the price of bond using PV table and then compute for I. So for the formula, yield to maturity is stated on the slide.